All right, welcome everyone. Welcome Rupert, News of the Money World. How you doing?
Hello, how are you?
Very good, very good. There's a few things going on, so let's get stuck into it. We have like 6 or 7 points to get through today, so
Only six.
wish us luck, everyone.
We'll be super quick. 3 minutes
Yep.
ago.
All right, cool. Here we go. So first one, let's talk about the U.S. Fed announcement last week. It was a definite kind of mixed messaging thing. I was actually watching this one live. I've got this
Oh,
little
wow.
magnetic thing that sits in the shower. So when I'm having a shower, I usually watch these things, and my wife thinks I'm absolutely nuts, of course. But this is exciting for me. This is exciting times. It's like watching sport. And the message I got was higher for longer, but not necessarily higher interest rates. It was more like higher inflation for longer.
Yeah.
I would like to know your thoughts, though, Rupert. What do you think?
Yeah, look, it was an interesting announcement. Coming off the back of a couple of prints of higher CPI. So in the US, inflation has been coming in higher than what people had been expecting. US job data had been coming in stronger. And so I think coming into the meeting, everyone was kind of going, well, what does all this mean for the Fed? Increasingly, we'd taken the idea of kind of rate rises off the table rate cuts off the table till right at the back end of the year. Consistent for the last kind of 12, 18 months. We just pushed them further out. But I think what we're all looking for is going, well, hold on a sec. If we've got higher inflation, we've got increasingly starting to hear some murmurings on concerns around the economy. Does this mean we're heading for the dreaded stagflation? And does this mean actually the conversation needs to shift to higher interest rates, not actually interest rate reductions? And so that was kind of the context coming into the morning. And it was pretty kind of an event, but also a non-event, right? US Fed confirmed everything. They said inflation is proving harder to come down than we had expected. It is likely to stay higher for longer. We're probably not going to be moving anytime all that soon to push interest rates down. But we don't think that interest rates are going to go higher. And so that final part was the thing that markets took away on the day, right? It was all about, oh, awesome. So one of the big risk areas that markets have been focused on is maybe we might actually see interest rates go higher versus come down from here. That was effectively taken off the table. And post that, it was kind of an interesting one because we did see interest rates kind of the 2 years come down a little bit off the back of that announcement. And the problem is, though, every time we kind of take those things off the table and say that they're not going to happen, financial conditions ease, which means that money becomes more available. So when I say financial conditions ease, that means those slight shifts in interest rates, the downside in interest rates, stock market goes up. That makes people feel richer. That means they start spending more, which actually acts as a bit of a drag on the inflation fight as well. So, yeah, an interesting day. And I mean, I think one of the bits that I'm starting to wonder is have we got our kind of the head in the sand a little bit around actually just no way our interest rate's going to go higher. And we kind of are very comfortable where we're sitting. That's kind of doesn't align with where the data sits. And unfortunately, that pushes us closer and closer to that 1970s world as well, particularly when you overlay the Iran-Israel stuff, where actually in the 1970s, what caused the big spike in inflation when it was already high? The Iranian oil crisis.
Yeah. It's weird. The wiring seems to have changed around, though. And what I mean by that is the interest rates going up. Typically, you interpret that as that's not really good for markets, right? It's going to bring markets down. But in this case, taking higher interest rates off the table, delaying rate cuts, I just wonder if the pathway or the logic has changed somewhat in that, well, that means that somewhere along the line, there's going to be, I don't know if this is the right terminology, but there's going to be some more debt monetization as the U.S. government has a hard time raising money, maybe, in the bond market to roll over its interest payments. And it's just going to have to consolidate that. Correct me if this sounds not quite right, but it just doesn't seem right. Like it's almost like the fight is being given up against the fight, and the fight against inflation has been given up, and therefore the market seems to be interpreting that as, well, there's going to be more liquidity now in the market, therefore more cowbell, right? It's all gone, it's all
Yeah.
on, and markets are going to go up. Do you think that that's playing a part?
Yeah, I think there's definitely a bit of that. More liquidity in the market. Markets keep on going up. Everyone's kind of pretty confident. But I think it is, we are seeing, so yeah, coming back to your point on wiring, it is a bit weird, right? So last time in September last year, where we had the big kind of move in interest rates, and kind of peaked at, kind of went up to where they are now, actually, about 4.5%, 10 years, etc. We saw the markets drop 10, 12% in that month. Last month, where we've seen exactly the same movement in interest rates, but we only saw markets drop 4 or 5. And actually, over the last kind of 3 or 4 days, a lot of that's been recovered as well. So I do think, I think the truth is markets have just got no idea what's happening right now. And we talked about it a bit last week. But no one's quite sure, because we've all been burnt so badly in terms of our predictions over the last 6 months that actually everyone's kind of going, whoa, not really sure. That's why you see Tesla and the very strong movements. Tesla announces kind of a approval to do some self-drive in China, and that's a 20% up. Apple, where they kind of revenue was slightly declined, was still negative, but wasn't as bad as everyone thinks, and they're up kind of 3 or 4%. So we are seeing these massive moves in the market, which I just think is indicative of no one is really sure of where this thing is and where it's going.
Yeah.
And that's why, and I think everyone's just getting fatigued. They're getting fed fatigue, where no one's kind of like, just what does it all mean?
Yeah. What does it all mean? This existential market crisis meltdown, right? And so what about the inflation piece then? Because if the markets are still going bananas with the higher for longer inflation narrative now, then is that feeding through to the earnings? Because the earnings might be a little bit meh in some areas, but with tech or with areas where there's significant pricing power, then I guess inflation means that they have a bigger license to print bigger piles of cash.
Yeah.
And so do you think that's creating a distortion as well?
Yeah, look, there's no question that investors are consistently pleasantly surprised at the earnings path. So we look at, kind of just been through Q1 earnings in the US, 80% of companies have beaten estimates and beaten where they expected to be. That's well ahead of the long-term average of those beats. Companies will always beat. Number one rule in investor relations is guide to a number that you think is fine, but that you think you can beat, right? Because everyone hates a fail. And everyone loves a win. So we're definitely starting to see company earnings are holding up well. I think it's a really good reminder that actually in a high inflation environment, equities are a really good bet, because as revenues go up, profit goes up, and you it is a nice inflation hedge. But we're also seeing some big kind of underlying moves in the market as well, right? Where you do have the tech behemoths, which we've been talking about a lot. So you kind of go NVIDIA, Amazon, Microsoft, Google. These are all businesses that are making a hell of a lot of extra money because of AI. In the case of Amazon and Google, it's because they've got some big cloud businesses that are kind of churning extra data. Main Street, the numbers that I looked at last week that shocked me, inflation and banks are doing really, really well at the moment, which is indicative of the higher interest rates. So again, Main Street, Wall Street, very different. But we have actually seen some great earnings, but we're also seeing some interesting perspectives from investors, right? Because rather than focusing on today's earnings, they're all going, well, I kind of am relatively comfortable for today. What does that mean over the next 12 months? And that's where the guidance from corporates at the moment is really scary. It's not scary. It's just pretty scant. They're unwilling to be pretty clear on guidance because even they are so uncertain of their current operating environments.
Yeah. Okay. No one knows how things work, but it just works. So let's just keep going, right?
It does. I mean, the pit that we've got to come back to, right? That 21 times PE as a market, it kind of sits there. And that's what we talked about last week around whether markets are real or not. It is all over the place. And I think in the current environment, it's all about, we've got to learn our advice as financial advisors is don't react to short-term market moves and don't react to short-term news. And the markets, unfortunately, don't like that approach. And so we're seeing big movements on very little news, which is reflective of the uncertainty that's out there at the moment.
Yeah. When you zoom in on anything, it always looks rough around the edges, but when you zoom out, it's smooth, and that's kind of
Oh,
up
yeah.
and to the right over the long term, right? Not financial advice, of course, but that's pretty much what happens, right?
I'd be comfortable giving that as financial advice, Darcy.
If in doubt, zoom out. So, but there's a couple of really interesting big themes going on. Last week
Yep.
we talked about the yen to US dollar, and the big dump that happened when I think it's common knowledge now that Japan intervened in their currency to bring it down. And that obviously wouldn't happen, in my view anyway. That doesn't seem like that's possible for that to happen without some sort of conversation going on with the US. And it caused me to dig a little bit deeper into the whole US dollar thing. You mentioned before that it looks increasingly likely as time goes on that we're going back to the 1970s. We're seeing a repeat of that, maybe that stagflation story rolling out. The thing that was different with the early 70s was that was kind of the birth of the US dollar, or the petrodollar system, where there was this kind of agreement that the US would be the world's policeman as long as oil was traded in US dollars. That created a demand for dollars, which meant that there was always a demand for US treasuries, which was a form of borrowing. So in this way, it was kind of like the US sucks up the value from all over the globe, pretty much, through the dollar system that they dominate the world with. And what I read recently on an X post by a fellow by the name of Craig Shapiro was really interesting, because his kind of thinking is that, and I'm paraphrasing a post here on X, is that he believes that there's a shift in stance on the oil trade to support transactions in non-US dollar currencies, which is kind of the opposite of what we would have seen in the early 70s, when it would have been, I can't remember his name, doing deals with the Saudis to do that petrodollar thing. Gold is a neutral settlement asset. The aim is to reduce U.S. Treasury sales, get the dollar weaker, lower interest rates. Side effect, less need for war. Not implying, of course, that the U.S. causes wars all over the world to protect their hegemony, but I guess it's just an interesting dynamic that I get, going back to what we were saying before. Sometimes the wiring or the strings that connect all these variables, sometimes they can change and they can get remapped without our awareness until we look back. And in hindsight, we can see that maybe there was a shift. And when I looked at that yen story, it kind of makes sense, because if there's less, like if people start dumping, not people, if nations start dumping U.S. treasuries, well, what does that do to interest rates? Up we go, right? So does that logic make sense on your end? Because it's starting to make a little bit of sense on my end, which usually is a danger sign, because it means I've missed something really big. What can you find in terms of holes in that one?
I think there's two things, right? You are 100% right, and that if there are less and fewer buyers of US treasuries, theoretically that should push up interest rates. The problem is it's such a massive market, and I think I want to say kind of 60 to 70% of US treasuries are domestically held anyway. So you're kind of going, well, actually, how much pricing power is given to by those international people when they come and dump, etc. So, look, I'm a little bit. My view would be I don't think that the foreign countries are in there to push up interest rates or impact US interest rate policy. It's a simple case of they're trying to protect their local consumers from expensive imports. The problem that they all have, and this is why, the problem they all have is that the US has got high interest rates. It's going to have higher interest rates for the conceivable future, versus most of the other big managed economies, so Japan, Australia, and Europe, who are all kind of going, actually, we're coming down the other side and we're all reducing interest rates, and they're not even as high as where they were. So you've just got this massive underlying demand. And this is one of the big reasons why everyone looks to the Fed to set a whole lot of that FX policy, the interest rate policy, because they don't want to be an outlier. You're an emerging market. Say, for example, you might be Cameroon, where you've done most of your borrowing in US dollars. All of a sudden, US dollar interest rates go high, are staying higher. You're having to push yours down. Your local currency tips, so your local currency drops significantly, And then you've got all of this US dollar denominated debt that becomes really, really expensive. And so that's kind of why we've seen in the past emerging markets have really struggled when the US dollar strengthens. And there is no doubt about it. We are in a very strong US dollar environment right now. The economic strength of the US economy is driving that. Higher interest rates is driving that. So far, we haven't seen the chaos and the carnage that often causes. And I think that's due to a combination of the decoupling from other parts of the world. And yeah, I mean, the Japanese are the only people that seem to be particularly put out by this move so far. So to me, what's happening right now comes back to, I mean, it is probably the most logical economic thing that it is happening. It's kind of what they teach us in economics 201. Interest rates move based on interest rates. FX rates move based on interest rates. And that is exactly what we are seeing here. Is there the broader shift, and will we wake up one day to realize that the US dollar is no longer as powerful as it was? Yes, there's no question on that, right? Where you look at Iran, China, Russia, broad parts of the economy, of the global economy, which are increasingly saying, hold on a sec, we don't want to operate in US dollars anymore. Does that put a risk to US interest rates? Potentially. But I think we're a long way away from that.
Yeah. And there seems to be a part of the story that just still feels like it's missing, though, around going way back, probably 3 years ago, we would have spoken at the time around the US kicking Russia out of the SWIFT system. And that would have been interpreted as a really dumb move. And right now, kind of allowing the BRICS nations to form their own currency bloc. Some say they are, some say they aren't. Again, it looks like a period of weakness, but at the same time, we see central bank synchronicity. And that to me means that at all cost, all these other central banks that are kind of aligned with the US Fed now, it seems, are going to be finding reasons, whatever they are, to keep interest rates higher for longer, so that there is like a consolidation of power going on. So it really is like part of a geopolitical story, I think. I just can't quite connect the dots. We'll probably know in the next couple of years, though, I suspect.
I think we will. And I think I still believe that the SWIFT, what they did to Russia around SWIFT, will actually, in hindsight, will be seen to be a bit of a dumb move, because I do believe that, well, put it this way, so we are now seeing those three countries plus India are sitting there going, well, that's fine, we'll just start trading around it. And they've almost proven to themselves that they can still operate. I mean, the Russian economy is likely to be bigger this year than it was pre-war, despite all of the sanctions, despite that. And unfortunately, what they've demonstrated is that, you know what, we can actually operate outside of that US-based financial system, and we can be successful. And as you're moving to, I don't know what the number is, but what have you got? 1.5 billion people in China that operate like that. You've got Russia with another couple of 100 million. You've got Iran. India kind of likes to play both sides, and kind of huge parts of the world and huge parts of the global economy are increasingly moving outside of it.
Yeah, it's interesting, isn't it? And I guess like where it comes to hit most people, most households, you'd be the same. I'd be the same. Like a lot of people I talk to are the same. Where it hits home is, yeah, sure, the value of our portfolios, the value of our investments might be sensitive to where interest rates and inflation go, yes. But more immediate is the interest cost, which, let's say your mortgage payments might typically be 30 to 40%. Well, at the moment, 40 to 50, maybe even closer to 60% of your income going towards servicing a mortgage. And so managing the risk has been probably one of the biggest things, right? Like, I don't know if you've been caught out, Rupert. I won't ask your details in terms of how your mortgage is structured, but I am confronted weekly by people that are not confronted like accosted on the street or anything, but I'm confronted with just the reality of people struggling now because they would have followed slightly optimistic, hopeful thinking that interest rates would have fallen, right? And were you in that category, Rupert?
That's why I refixed mine from 2.25 up to 6%. And that was a painful move, I'm not going to lie.
Yeah. Well, and a lot of people would have done that a year ago, expecting that rates would be significantly lower, only to find that, hey, rates are pretty much exactly the same, right? And so I keep on going back and saying, well, it's not actually about speculating on where interest rates are going to go. It's about managing risk, much in the same way that with investing, it's all about long-term objectives and constructing a portfolio which is clever and smart for the long term, not the short term. With your mortgage being the biggest expense, what's the biggest risk? Well, the biggest risk is that you're not going to be able to afford the mortgage, and then you're going to have to sell the property under pressure, which is a horrible thing for people to have to go through. And if you could afford a longer term fixed rate, in some instances, that actually makes a lot of sense. And now what we're seeing is that interest rates and inflation are probably going to be here higher for longer. And part of the reason why might be to inflate away government debt. But as it relates to our situation, if we can afford it, again, and if you're managing your risk really well, the good news with this period of high interest rates is that the balance on your mortgage doesn't go up. But inevitably, because of inflation, that house price has to go up, right? And so it's still a good bet to get into debt, as long as you're buying an asset which is appreciating in value relative to the currency that bought it. So yeah, like I don't know what to say around, like, if somebody was fixing their mortgage, what should they do right now? Because it depends on their individual circumstances. But I would definitely like to take the opportunity of just saying, hey, to people, it's all about managing risk, and it's not about speculating on where interest rates are going to go.
Very similar to what we say about KiwiSaver.
Exactly.
You kind of short-term investor, manage your risk. Long-term investor, do different things. You shouldn't be making decisions around where interest rates are or where the markets are at. You should be making decisions on how you manage your outcomes and you manage your long-term risk. It's fundamentally financial, in my view, financial success and investment success. It's actually all about risk management. And you nail that, then you're always going to be alive to take the options. And I think that's what people don't realize. They always go for the quick wins versus managing the downsides.
Yeah, absolutely, 100%. And I think, and even as it comes to risky assets like Bitcoin, and I guess this is where we probably have to get into more of a philosophical discussion around the differences between volatility and risk. But when it comes to volatile assets like Bitcoin, where it can go up and down like a yo-yo, traditionally, most investors would look at Bitcoin as one of those high-risk investments that might be a good play, but only invest an amount that you're willing to lose, type thing, and a very small amount to be safe. And that's, maybe that's generally good advice, but I think as markets mature, as the market cap for Bitcoin in particular matures, we're probably going to see a similar dynamic play out, that maybe in a world which is fundamentally different to what it was before, maybe what was risky is actually relatively safe. This is my hopeful safe haven status being applied on Bitcoin here again, right? But we've seen some interesting developments with the Bitcoin ETF. So the outflows that we've seen over the last couple of weeks has been an interesting indicator. I'd love to know your opinion, because it feels like that's provided a nice, solid, regular, dependable base of buyers on Bitcoin. However, they're a newer market participant, and they might not understand the volatility yet or appreciate the volatility. That is actually a good thing in the long term. And it feels like maybe some actors are dumping at the moment. Maybe it's retail, I don't know. But we're seeing some pretty significant outflows, aren't we?
Yeah, and so I'm just trying to bring up my numbers. But yeah, so look, over the last 3 weeks, we've seen about $1.7 billion of outflows out of those funds. Which is a fairly big set of numbers, right? And that's been primarily, like last week alone, there was $900 million, which came out of those funds. It's still small in the scheme of things. But it is a pretty wild move. And interestingly, it has been coming across all of the ETFs. So last week in particular, even the Fidelity ETF, the iShares ETF did see some pretty big outflows. And so, look, there's clearly, whether it's kind of the market's gone too far, I think we have seen a bit of a risk sentiment shift in sort of the broader markets over the last couple of days as well, over the last week or two. And I personally, I suspect that it's more down to that than anything else. Right. The comfort, though, which is really interesting, I find, is that last week when we had a $900 million outflow week, the price of Bitcoin dropped from $63,500 down to $62,800. So it hasn't really moved. So it feels as though the bigger driver is on the upside. And so where we've got big buying coming in, that's driving prices up pretty rapidly. But luckily, so far, we haven't seen the same level of volatility and the same impact on the way down. I mean, it's that level of buying, to be fair, I would have suspected does impact the price a bit more, because we know Bitcoin is a bit of a liquidity trap. Hard to get in, hard to get out, and prices move pretty quickly. But yeah, it is interesting, and I think it just shows that further evolution of the product, which is what we'd all hoped when those Bitcoin ETFs were approved.
Yeah, agreed. And you mentioned evolution, like Bitcoin itself as an asset.
Yeah.
Maybe it's not evolving, not that much, but our interpretation of it is evolving. And like it teaches you how to be it teaches you how to be a much better investor than what you were before. That's what I personally like about it, because it really does teach you early on that if you're in it for a short-term gain, you're going to get your face ripped off. You shouldn't be trading. You shouldn't be speculating. You should be buying and holding. So if anyone needs to learn that lesson quick, just hold some Bitcoin for a while and then you will, right? So it's a great educator. But the other thing that's interesting is that the Bitcoin ETF, so this is what I would call financialized Bitcoin. You will see the benefit of price appreciation of Bitcoin, but you won't actually be able to interact with other people using Bitcoin. In other words, you won't be able to use it as a form of money, not unless you use some of the other, that's probably another conversation, some of the other ETFs, which you can take it out. But with this, that's a different type of Bitcoin in a sense, because it's not, you can't use it as money. Whereas the Bitcoin that you hold in your wallet, well, you can use that as money peer to peer. And so you can benefit from more than just price appreciation. And then going further, I think there's other layers, depending on how deep you want to go, where there is what's called virgin coin, where maybe you get in contact with a miner, or you are a miner, a Bitcoin miner, and you're creating Bitcoin from the network through mining activity. And that Bitcoin has never existed before. So from an AML KYC point of view, it's untouchable, or it's untraceable in a sense. And then you have other options where I guess you could transact with other users of Bitcoin by connecting a node to a wallet. So there's these different layers of the same asset, but you could actually have diversified, or not diversified, but you could have, I guess, non-fungible forms of Bitcoin emerging over time. Any thoughts on that?
It's no different to gold.
Yeah, true.
I mean, right. Let's be honest, that's how most of our most of our assets are, right? And all of these assets, they can be kind of stored somewhere. They can be stored by a third party. You can buy them as an ETF. You can buy them as different financial products. You can use them as jewelry. They can be collector's items. I mean, this is why there is so many different ways, and increasingly, that's what we are starting to see with this asset class as well, right? It is just simply following the other asset classes and becoming much more diverse in how it's accessed and how it's used.
Yeah, it's cool, isn't it? So, yeah, now that I think about it, thinking out loud on the spot here, but yeah, like even just with shares, you could set up your own business. You could do a private offering. You could do a public offering. It could be sandwiched into a managed fund, and on it goes, right? And it could be the exact same thing, but you're diversified on the custody layer. And it just provides a different sort of texture, I guess. And when you're thinking about your overall investment portfolio, you're kind of trying to think both horizontal and vertical, right? In terms of how am I holding this asset and how diversified is that versus how many different types of assets am I holding in this direction as well? So there's always fun stuff to kind of dig into. Like I love
that area. It's the rabbit holes that you could go down for months and months and months on end without ever coming up.
Yeah. I'm like fully in a rabbit hole right now with this one. This is good. Just don't pour any water down that rabbit hole while I'm down there. I'll be back soon. Don't worry. That's cool. Okay, well, we've covered a lot of ground. So we've covered the Fed announcement last week. We've talked about higher inflation, higher interest rates for longer. We talked about earnings, U.S. dollar strength, a little bit about mortgage strategies, Bitcoin ETFs, and the outflows. Anything else that we should finish up on before we finish up?
No, I think that's a pretty comprehensive conversation, to be honest.
I think it is.
And we haven't done too much rambling as well. We've actually been pretty direct to the point, in my view.
Well, that's good. In our own opinion, we're like,
in our opinion, we're perfect.
In the world. Yeah, that's right. So we shall go home and tell our wives this, and they shall remember this long term. That's good.
Oh.
Cool. You've gone missing, Rupert. But I'll say goodbye to everybody who is still able to see me. Thanks for watching, everybody, on News of the Money World. We'll catch you next week.
Thanks, Darcy. Great to speak to you.
Cheers.
Bye.